In 1917, America was handed the highest credit rating on Earth, AAA. It meant one thing: the United States always pays its debts. For 108 years, that rating held, through 2 world wars, through the Great Depression, through Vietnam, through 2008. Then, on May 16, 2025, it was gone. 3 crises are now converging on the American economy. Most people do not know all 3 are connected. Right now, oil prices are surging because of conflict in the Middle East. And artificial intelligence is quietly eliminating white-collar jobs faster than most people realize. And yet, the stock market is sitting at record highs. That contradiction is not a glitch. It is not a mistake. It is the story. Because beneath those record numbers, the American economy is splitting in 2. One side owns assets. The other side is getting squeezed. This is Uncut. And today, we connect the dots. Let us start with oil, because this is where inflation could come roaring back. Earlier this year, military escalation involving Iran disrupted traffic through one of the most critical choke points on Earth. The Strait of Hormuz, a narrow strip of water, just 21 miles wide at its narrowest point. When that route gets disrupted, the world pays. Oil prices surged, gas prices across America jumped, airlines raised fees, shipping costs climbed, and the Federal Reserve, which had spent 2 years fighting inflation, suddenly had a brand new problem. Here is what most people miss. When energy prices rise, everything becomes more expensive. Food, flights, Amazon deliveries, manufacturing. Almost every part of the modern economy runs on oil. And this is where it hits you directly. If inflation stays elevated, interest rates stay higher for longer. That means expensive mortgages, expensive car payments, and expensive credit card debt. Wall Street's biggest fear right now is not just inflation. It is something called a supply shock recession. That is when the economy slows down, but prices keep rising anyway. America's national debt has now crossed $36 trillion. But the terrifying part is not the debt itself, it is the interest. The United States government is now spending more on interest payments on its debt than it spends on national defense. More than the entire defense budget. Not schools, not infrastructure, not healthcare for veterans, just interest. Most people hear national debt and immediately tune out. That is a mistake, because Treasury yields set by government borrowing influence almost every borrowing cost in the entire economy. When government debt becomes riskier, your debt becomes more expensive too. Mortgage rates stay high, auto loans stay high, credit card interest stays painfully high. The 10-year Treasury yield spiked to 4.56% the morning after the Moody's downgrade. And Congress is now considering an additional $4 trillion in tax cuts over the next decade. That would make all of this significantly worse. Both sides agree on one thing. America cannot keep increasing debt faster than economic growth forever. Something eventually has to give. Now, the third crisis. The one nobody is talking about loudly enough. Because while everyone debates AI's potential, companies are already making decisions behind closed doors. The tech industry laid off nearly 80,000 employees in just the first quarter of 2026. Almost half of those cuts were directly attributed to AI. Amazon announced 30,000 job cuts across 2 rounds of layoffs. CEO Andrew Jassy stated directly, "As we roll out more generative AI and agents, it should change the way our work is done. In the next few years, we expect this will reduce our total corporate workforce." Here is who gets hit first. Entry-level workers. The Federal Reserve Bank of New York found that recent college graduates aged 22 to 27 now face an unemployment rate of 5.6%, compared to the overall rate of 4.2%. Entry-level job postings have dropped 35% since January 2023. The hardest hit fields: marketing, legal, accounting, human resources, customer support, finance analysis. Every job that used to be the first step on the career ladder for millions of American college graduates. Anthropic CEO Dario Amodei has predicted AI could wipe out half of all entry-level white-collar jobs within 5 years. The AI disruption story is being told wrong. Companies are not firing, they are freezing hiring, and that distinction changes everything. So what are the people who understand this actually doing with their money right now? First, they are staying liquid. High-yield savings accounts and short-term Treasury bills are still paying 4 to 5% with minimal risk. In an uncertain environment, cash that earns a return is a weapon. Second, they are focusing on quality. Companies with strong cash flow, strong balance sheets, and direct exposure to long-term AI infrastructure spending. Third, they are avoiding unnecessary debt, because in a high-rate environment, financial flexibility is worth more than almost any investment return. And fourth, they are paying close attention to what AI is doing to their industry, because the workers who learn to use these tools early will be rewarded, and the ones who ignore it will not. Here is the bigger picture. America is not collapsing. The economy is still growing. Companies are still investing. And AI genuinely could create enormous wealth over the next decade. But underneath that optimism, 3 major pressures are building simultaneously. An energy shock that ties your mortgage rate to a conflict in the Middle East. A debt problem that America's own credit agencies are now formally warning about. And the labor market transformation that is arriving faster than most people or most policymakers are prepared to admit. These are not separate stories. They are connected. And together, they are reshaping the American economy much faster than headlines are catching up. Major economic transitions do not announce themselves clearly. They arrive quietly, in the form of shifting job markets, rising borrowing costs, and stock charts that no longer reflect what most people feel. The 1970s oil crisis created the energy industry fortunes of the 1980s. The 2008 financial collapse created the greatest stock market rally in history for those who stayed invested. And the AI and debt transition of the 2020s is already creating winners and losers, long before most people have noticed which side they are on. The people who understand these shifts early have an enormous advantage, not because they can predict the future. The next few years may produce some of the biggest wealth transfers of this decade, not because the economy is ending, but because the rules are changing. Energy, debt, artificial intelligence. 3 forces moving at the same time, in the same direction. And most people still have not connected the dots. That is what Uncut is here for. No spin, no agenda, no noise. Just the real story, behind the numbers, and what it means for your money. If this video helped you see something you did not see before, subscribe, because the next phase of this economy is already starting. And this time, you are not going to miss it.